The Great Retreat. When a DAO confesses its love for the state, a promise was made to you. A story of a new world, built on tokens and trustless code. But when the doors to the old world of contracts and capital opened, the revolutionaries were the first in line. And the market, in its infinite and brutal honesty, applauded the surrender. You have to look closely at the numbers on the screen. Not as a trader, not as an investor, but as an observer of human action. What do you see when a token, a symbol of a supposedly decentralized future, rockets upward by 80% in a single day? You are not seeing a vote of confidence in its technology. You are not seeing a breakthrough in its utility. You are seeing a confession. You are witnessing the raw, unfiltered voice of the market screaming a single uncomfortable truth. The promise of a traditional, legally binding, centralized corporation is infinitely more valuable than the fantasy of a decentralized autonomous organization. The token is called ACX, the Project Across Protocol. They built a bridge not just between blockchains, but between a narrative of rebellion and the reality of compliance. For years, the story was the same one you've heard 1,000 times. Tokens are better than shares. DAOs are superior to corporations. Decentralization is the future. And then one day, the builders of this new world published a proposal, a quiet admission of failure dressed up as a strategic pivot. They said, and you must appreciate the honesty in the language, that the token and DAO structure has materially impacted our ability to close partnerships. Let us translate this for you. What they are saying is that the very thing they sold as a feature was in fact a bug. The costume of decentralization, the performance of community governance, was scaring away the real money. The institutional partners, the enterprise clients, the ones with lawyers and balance sheets, they looked at the DAO and saw not a revolution, but a risk, a liability. A group of anonymous actors with no legal standing, no one to sue, and no contract that could be enforced in a court of law. So the purposeful action of the team was to seek a remedy, to escape the very structure they created. Their proposal is simple. Dissolve the DAO, burn the token's utility, and become what they once claimed to replace, a USC corporation. And what was the market's reaction to this grand retreat, this ideological surrender? It was euphoria, greed, pure and simple. The price surged from 3 cents to over 6 cents. Why? Because the proposal offered an exit, a parachute woven from the fabric of the old world. Token holders were given 2 choices, and neither of them involved the decentralized future they were promised. Option 1. Exchange your ACX tokens for shares of equity in the new Acrosco. Become a stockholder in a traditional company with all the rights and regulations that entail. Option 2. Sell your tokens back to the protocol for a fixed price in USDC, a centralized stablecoin, a cash out at a 25% premium over the recent trading price. You see the beautiful, painful irony here, don't you? The 2 paths offered are a return to the familiar cage. One is the cage of corporate law, the other is the cage of a centrally issued dollar proxy. The path of the DAO, the path of the token as a sovereign instrument of a new digital economy, that path has vanished. It was a mirage. The market's 80% pump was not a bet on the future of a cross-protocol. It was a stampede toward the exit door, which was suddenly marked with a price tag. Traders flooded in, not because they believed in the long-term vision, but because they saw a clear, simple arbitrage. The buyout offer of $0.04 created a floor, a safety net. The price on the screen simply floated up to reflect this new reality. The speculation you see now, the price hovering above the buyout offer, is a bet on one of 2 things. Either the buyout price will be negotiated higher, or the equity in the new centralized company is perceived as being even more valuable. In every scenario, the DAO is worth nothing. The token's value is now entirely derived from its potential to be extinguished and replaced by a traditional asset. This is the moment where we must pause and ask the question that the DeFi proponents have avoided for years. What was the purpose of the DAO in the first place? Was it truly a superior form of governance? Or was it simply a clever mechanism for capital formation in an unregulated environment? A way to distribute tokens that looked like equity, behaved like equity, but cleverly sidestepped the legal frameworks that govern equity. The actions of the Across team provide the answer. The DAO was a vehicle for a season. It raised funds, it built a community, it generated hype. But when it came time to do serious business, to enter the world of enforceable agreements and institutional capital, the vehicle was abandoned on the side of the road. They are not the first, and they will not be the last. You will see this story play out again and again across the landscape of thousands of altcoins. Each one is a ticking clock, counting down to the moment its narrative collides with reality. And here is the question that no one in that community call will dare to ask. If your decentralization was so valuable, why is the market paying you to abandon it? The silence that follows that question is where the truth resides. Now, let us contrast this with the only form of decentralization that matters. Bitcoin has no CEO. It has no board of directors. It has no legal entity registered in Delaware. Bitcoin cannot propose a temp check to dissolve its protocol and become a C Corp. Who would make such a proposal? To whom would it be submitted? The very idea is absurd. Bitcoin doesn't need to sign partnership deals with institutions. Institutions must re-architect their own systems to deal with the reality of Bitcoin. It does not bend to them. They must bend to it. Its contracts are not enforced by a court system. They are enforced by thermodynamics and cryptography. The cost to cheat the system is a cost of energy so vast, it is physically, not just economically, prohibitive. When a bank wants to integrate Bitcoin, it doesn't call a sales department. It hires engineers. It studies the code. It adapts to the protocol. The protocol does not adapt to the bank. This is the fundamental difference between a system of true, spontaneous order and a system that merely wears decentralization as a mask. The Across Protocol DAO was a social structure, vulnerable to the fears, hopes, and ambitions of the humans who comprised it. The team feared irrelevance. They hoped for institutional validation. They had a high-time preference. They wanted success now, within the existing system, rather than waiting for a new system to emerge. Their actions were perfectly rational. They chose the path that they believed would lead to their desired end, profit, and sustainability. But in doing so, they revealed the nature of their creation. It was not a protocol, it was a product. It was not a foundation. It was a facade. Bitcoin is not a product. It is a force of nature, like gravity or the speed of light. It operates on a set of rules that cannot be voted away. Its value does not come from a promise of future partnerships or a potential conversion to equity. Its value comes from its absolute, predictable, and incorruptible. It comes from the fact that it has operated for over 15 years without a central point of failure, without a bailout, and without a CEO to propose a strategic pivot back to the safety of the old world. Look at the mechanics of this proposed transition for Across. Holders of more than 5 million ACX can convert directly to equity. Smaller holders must pool their tokens into a special purpose vehicle, an SPV, to gain access. Even in their retreat, they create new layers of centralization and new classes of stakeholders. The promise of a flat democratic DAO structure dissolves into a tiered system that favors the wealthy. The very illusion of equality is the first casualty of their return to the traditional world. The trading volume tells its own story. $149 million in a single day, 3.5 times the token's entire market capitalization. This is not the behavior of a committed community carefully weighing a governance proposal. This is the behavior of a swarm of speculators, drawn to the scent of a predictable, short-term trade. It is the sound of hot money, flowing in and out, indifferent to the project's mission, caring only for the spread between the market price and the buyout floor. The governance discussion, the community call, the snapshot vote, these are all just formalities. The market has already voted. The verdict was delivered in the first few minutes after the announcement. The verdict is that centralization is profitable. The verdict is that the DAO was a dead end. This event is a gift. It provides a moment of perfect clarity. It allows us to see the true nature of these systems. They are not protocols competing with Bitcoin. They are startups, using the language of decentralization as a marketing tool. And when that tool no longer serves its purpose, it is discarded. So when you see the next project launch with a DAO and a governance token, promising to revolutionize some industry, remember this moment. Remember the 80% surge that celebrated a return to the old ways. Remember that fear doesn't destroy markets. It reveals who is pretending to be brave. The fear of being left behind, the fear of legal ambiguity, the fear of institutional irrelevance. This is what drove the proposal. And the greed of the market is what validated it. The question isn't whether a token can become a stock. We are seeing that it can. The question is, what was it pretending to be in the first place? And how many more of these confessions are waiting to be written in the language of price? The answer is already there in the code and the incentives, in the very structure of these thousands of experiments. You just have to know how to look. We are blocks on it. We don't predict the market, we read its memory. Never forget, Bitcoin is only yours in your cold wallet.